Okay, so let's get right into it. A lot of people see setting up an LLC as just a task, a box you have to check off. But that is a massive misunderstanding. We're going to reframe this whole thing because an LLC isn't just a piece of paper. It's a powerful, strategic financial tool. And honestly, structuring it correctly can be the difference between success and, well, failure.
So to really get a grip on this, we're going to break it all down into 5 core principles. Now, I want to be clear, this isn't your typical step-by-step guide. Think of this more like a strategic blueprint. We're going to focus on the why behind the what, so you can build your business on a foundation that's actually solid as a rock. All right, so let's start with principle number 1, seeing your LLC as that strategic blueprint. It is so easy to get lost in the weeds of paperwork and filing fees, but the real power of an LLC, it doesn't come from just having one. It comes from mastering the principles that make it work, and then using them to protect yourself and grow. And this quote right here, it just says it all. The way you set up and run your LLC can either be the fuel for your success, or it can literally sabotage it from the inside out. Those decisions you make on day one, the structure, the habits you form, they have these long-lasting consequences that ripple out for years. Getting this right from the beginning is all about preventing huge, costly mistakes down the line. And speaking of huge mistakes, that brings us right to our second principle, the separation doctrine. This is it. This is the bedrock, the whole reason an LLC even exists. It's all about building a strong legal wall between your business risks and your personal life. We're talking your house, your car, your savings account. So you really have to ask yourself, how strong are the walls of your financial fortress? Because this protection, it isn't automatic. It is not a set it and forget it kind of deal. The strength of those walls depends completely on how you maintain them. Because you know what? A single tiny crack can bring that entire structure tumbling down. And the single biggest threat, the wrecking ball to your fortress, is this one little word, commingling. It's just a fancy term for mixing your personal and business money. Using your business account for groceries or paying a business vendor from your personal checking account. If a court sees this, it's a huge red flag that says, hey, there's no real difference between you and your business. And just look at this chain reaction. It's a direct path to disaster. First, you mix the funds. Second, a court proves that commingling happened. Third, they do something called piercing the corporate veil, which basically means they shatter your LLC's protective shield. And finally, that lawsuit against your business can now come after your personal assets. And just like that, in 4 simple steps, the entire reason you created the LLC in the first place is gone. So how do you stop this from happening? Well, you build that wall with 4 tools that are absolutely non-negotiable. First, you get an employer identification number, an EIN from the IRS. That's like your business's social security number. Second, you use that EIN to open a dedicated business bank account. No exceptions. Third, you get a formal operating agreement in place. And fourth, you keep clean books that prove everything is separate. Every single one of these is a critical brick in that wall. Okay, once that wall of protection is in place, we can move to the next level. This is our third principle, the income equation. See, it's not just about protecting what you have, it's about optimizing what you earn. The LLC is super flexible when it comes to taxes, but you have to understand the equation to make it work for you, not against you. Which leads to a really important question. Is all of your profit actually working for you? Or is a massive chunk of it just disappearing into taxes, all because of a less than ideal structure? For most new LLC owners, the answer, unfortunately, is the second one. And here's the number you have to burn into your brain. 15.3%. This is the self-employment tax. It covers Social Security and Medicare, and it applies to every single dollar of profit in a standard LLC. As your business grows, this tax becomes a serious financial drag. So, the key to a good tax strategy is realizing that not all income is created equal. You've got 3 main types:
Most active businesses are making what's called ordinary income. And yep, that gets slammed with the 15.3% tax. But then there's passive income, like from rental properties, and portfolio income from investments. Those are treated differently. Just knowing which kind you're making is step one.
So if you're making that ordinary income, what's the move? It's a strategic play called the S-Corp election. Now, once your profits start consistently hitting around $50,000 a year, this becomes a really powerful option. You tell the IRS, hey, I want my LLC to be taxed like an S-Corp. It changes the whole income game, but fair warning, it does add some extra work, like running payroll.
Let's look at a real example so you can see the difference. With $100,000 in profit, a standard LLC pays that 15.3% tax on the full amount. That's over 14 grand in taxes. Ouch. But with an S-Corp election, you pay yourself a reasonable salary, let's say 30 grand, and that gets taxed. But the other 70,000, that comes to you as a distribution, which is not hit with that self-employment tax. The result? You just saved almost $10,000. Same business, same profit, just a way smarter structure. Now, that smarter structure isn't just about what you do, it's also about when you do it. And that is our fourth principle, the timing imperative. Seriously, the order in which you do things can be the difference between creating a huge risk for yourself and unlocking a hidden opportunity. So I want you to really think about this for a second. Does your current timeline create risk? Are you maybe doing things out of order without even realizing it? This is hands down one of the most common and most expensive mistakes that new entrepreneurs make. Let me give you a classic example from real estate. The wrong way to do it, which happens all the time, is you buy an investment property in your personal name and then you form an LLC and try to move the property into it. This can be an absolute disaster. A lot of mortgages have what's called a due on sale clause, which means the bank could demand you repay the entire loan the second you transfer ownership. Plus, you could get hit with transfer taxes. Okay, now let's rewind and look at the right way. You form the LLC first. Then you get your financing and buy the property directly in the LLC's name from day one. By getting the timing right, you get instant asset protection and privacy, and you completely avoid all those risks we just talked about. See the difference? And hey, timing isn't just about avoiding risks, it's about grabbing opportunities. For example, according to tax experts, you can deduct up to $5,000 in startup costs in your very first year. But, and this is a big but, only for expenses you had before you made your first sale. We're talking about things like market research, setting up your website, all that early stuff. If you don't track it from the very beginning, that deduction is just gone. Timing is everything. This whole idea of thinking ahead leads perfectly into our final principle, which is that your LLC is an evolving structure. The framework that's perfect for you on day one is not going to be the framework you need on day 1,000. Your business structure has to adapt and grow right alongside your business. An LLC is absolutely not a set it and forget it kind of thing. To keep that liability shield strong, you have to do ongoing maintenance. That means filing your annual reports with the state every single year. It means keeping a registered agent. It means keeping your books clean. If you miss these simple steps, your LLC can fall out of good standing, and that can literally dissolve the very protections you worked so hard to put in place. So I'll leave you with this last question to really chew on. Take a hard look at your business and ask yourself, is my current structure built for where I am today or for where I'm planning to be tomorrow? Because thinking ahead, that's the difference between building a business that just gets by and building one that is truly built to win.